Hey everyone, thanks for joining me for this one. In this video, we're going to be talking about Topgolf Callaway Stock. This company just reported their earnings yesterday after the bell. The stock opened today about 10% down, made up a bit of ground, closing just about 7% down on the day. But in this video, we're just going to talk about why the stock got crushed today. We're going to go through a bit of their business overview, a bit of background on the company before jumping into the results they posted. Just doing a bit of a history check on this stock. It's been a really volatile name for a number of years now. Back before the pandemic, this one traded in this same range, about 22 and $17 for the most part. They acquired Topgolf or merged with Topgolf during the pandemic. I believe they owned a minority stake in it before that, but they really viewed it as the future of the industry, the future of golf, a huge revenue and profit accelerator long term. So acquired the company. I think the company actually went down here about 20% when they first acquired it, but eventually skyrocketed. The company hit $36 a share, has slowly for the most part been decelerating from there, which brings us to the last week where this stock's down another 12% from around $19 down to $17 here today. They have about 200 million outstanding shares, so at a $17 share price, the value of the company is at about $3.4 billion. So not a huge company in the grand scheme of things, but also not a small company or shouldn't really be too speculative of a company in terms of their market position and their ability to bring in revenue and expand their footprint. Going into just their business a bit and starting to get a bit of a look at their results that they posted. Their biggest and most important business is Topgolf. So for those of you who aren't familiar with Topgolf, it's essentially driving ranges, but that are very integrated with technology and innovation. But people pay a premium to be entertained there. They also sell drinks, food, etc. So it's really just like an entertainment epicenter that they're building as they expand Topgolf's across the country and internationally as well. So I think one of the main reasons why the stock went down is they've really put all their eggs in one basket with Topgolf. They talk about how Topgolf is the future of the company. They changed the name of the company to start with Topgolf. And they even do investor days just for Topgolf to really get investor attention on the Topgolf part of the business rather than the other segments. And it may have shot themselves in their foot a bit on this release, as the same venue sales growth was only 1%. So definitely weaker than what people estimated. They say within guidance. I think they just guided to growth. So people were probably hoping for more than 1%. And I know they're bragging about it as a consecutive quarter of growth, I guess, but 1% is definitely a significant deceleration versus some of the other numbers we've seen. Another thing that they rolled out, which I think also had people concerned at how same venue sales growth was only 1%, is Pi is essentially their platform that matches supply with demand. So if lots of people and lots of consumers are trying to book on a Friday night, they'll adjust the prices up for the best areas to play in terms of like a middle bay, they call it, and stuff like that. And then maybe on a Tuesday or Wednesday, the prices will adjust down. It's essentially their supply and demand revenue maximizing system. And the fact that they've now implemented Pi in over half of the Topgolf venues, but the sales growth was only 1%, I think had people a bit concerned because they talk about Pi very magically on all the earnings calls. And I think the assumption is this alone would drive same venue sales growth to a much higher number than the 1%. And then lastly, I guess this was a bit of good news. They opened 2 new venues in the quarter. So they're on track to open, I think, about 11 venues this year, but 9 of them, give or take, are in Q4. So it's good to get a couple more opened, alleviate that CapEx expense a little bit by turning a couple of those projects into revenue generating. But overall, the CapEx on this company is still very high given how aggressively they're investing and trying to build out Topgolf. I think they currently have close to 80, I'll say, as an estimate locations, and they've been building about 10 more a year. So they've gone from 60 to 70 this year to 80, and we'll see what the guidance is for next year. But I think it'll be probably somewhat similar. So building about 10 per year organically, entering new markets. And Topgolf is really the majority of what you're investing in, the majority of the story, the focus, the capex. So if you're looking at this company and you don't want to own like a premium driving range franchise, then you may be looking at the wrong company. Some of their other segments here, golf equipment, they say golf demand remains robust. They call out rounds played is up 5%, and they have strong market shares across some of the main categories here. I believe there have been reports on golf sales in general, not golf playing, but golf equipment sales trending downwards and decelerating. So they also probably have some category weakness on the golf equipment side to pair with Topgolf. And then lastly, active lifestyle. They've been acquiring some lifestyle and hiking brands. So they have like Jack Wolfskin, Travis Matthews. I probably will pronounce this one wrong, so I won't even try. And this area of their business actually seems like it's doing pretty well. So that's one area that, while a much smaller part and less strategic part of the business, they've been expanding internationally really well with Travis Matthews and some of the other strategic initiatives they're doing on active lifestyle have been paying out. But once again, in the grand scheme of things, it's small potatoes versus the other areas of their business, which is why the stock's seeing weakness today. Just a bit of an overview in terms of the macro on the golf industry here. So I'll just highlight a couple things. They like to highlight the average off-course age is significantly lower, 31 versus 46, which is on-course only, 31 versus 42 versus people who do both on and off. And for those of you who are a bit less familiar with this company, on-course is people who just play like rounds of golf, 18 holes. Off-course are people who play like mini putt, go to driving ranges, participate in golf, but not in a formal capacity. You see that as you go down, it's more higher percentage of females are off course only. Non-white is higher off course only, and a bit less people in terms of incomes over 100,000 are off course. So it's a bit more accessible from a price range standpoint. Going into their results. So in Q2, they had revenue growth of about 6% overall. So lots of that probably came from more overall venues versus a year ago. But what was more concerning is some of the other numbers here. They had income from operations actually down even on higher revenue. The other expenses were up significantly, which made their income down almost 35%. So they're not really managing this overly well quarter by quarter, ensuring that they're not being overly volatile. So that may have scared the market a bit as well. In terms of net income on a GAAP basis, they did fine, same with EPS. But when you look at it from a non-GAAP basis, net income was down 17%. Income before taxes were down 25%. Expenses were over double on 5% revenue growth. So I get the sense that some of this is just growth pains in terms of investing heavily in opening up new Topgolf locations, and that may not be overly favorable for a public company who has to report every 3 months in terms of the timing of those expenses versus when revenues are captured. And, potentially serves as an opportunity as someone who just believes in that franchise blindly and doesn't care about the growth pains and thinks 10 years from now, they're going to be in a much better spot in terms of how developed Topgolf's built out and how well they pay off and how as a percentage of revenue this capex will go down. But currently for investors who are more focused quarter by quarter, this is definitely not what they want to see in terms of expenses doubling over a year on single digit revenue growth, having huge implications for net income. And I think that's part of the reason why you're seeing the stock move down how it has over the last week here. Now, just looking at whole year to date, which is also an interesting story. So you see net revenues up 9% year to date. So it has decelerated in the last quarter to 5%. So that was a bit concerning. Earnings per share down 25%. And all of these other metrics We don't have to overanalyze them, but down between 20 and 50%, pretty much driven by the higher capex and expenses that the business is taking up this year. I think just with the macroeconomic narrative around interest rates and discretionary categories, it was really a focus on ensuring that they're spending responsibly, that they're not seeing high elasticity with consumer spend. And I guess on that point, they still aren't. They're growing their revenues, just not as much as they were before. But I think in terms of how much debt they're holding, which we'll look at in a minute, that's really what's concerned lots of investors in terms of income going down, debt levels going up, interest rates still very high, may not be positioning them very well to fully capture the opportunity in the years ahead in terms of amount they're going to be able to spend on capex, given that debt that they're building up. Going into their outlook here, you can see they did about $4 billion in 2022, and once again, the company has a market cap as of today of $3.4 billion. So they're trading at under 1x revenue. If they're able to build this out, get strong or reasonable net income margins, this company can potentially trade at a very low PE today down the road on today's prices, is what I meant to say. So it looks like they're going to grow about 10% on top line is what they're guiding. Based off of the year to date being 8% or 8 to 9% and last quarter being 5%, this may be a bit challenging to hit, but they reaffirmed it. So I guess they don't want to back away from it now. I think the gross debt is what's scaring some people in the same breath of it being under a 1x revenue trading company. The company's total equity value is $3.4 billion, and they have $2.6 billion in debt. I remember looking at this company last year and not liking the fact they had $2 billion in debt, and the fact that they're increasing their debt in an interest rate environment that's just gotten worse by 30% year over year to continue to accelerate build out is a bit concerning. They may be moving too fast, especially for the environment that we're in, and that's one of the main things as a potential investor with the stock on my watch list that I'm continuing to monitor. Continue to go on here, just looking at Topgolf financials. So this is just another thing that they report Topgolf almost separately, given how much of a focus it is for the company. But you can see on the top line, at least, they grew high single digits, probably that's 17, 18%. The EBITDA on the overall operation, just only $6 million. So probably not exactly what they wanted to have there. Venue, financing liability, financing interest, both up. Financing liability pretty heavily over $300 million there. And then going into capital allocation. So on this one, they have their first one in investing in high ROI opportunities. They've made it clear that that's investing in building out new Topgolfs. Number 2 is maintaining healthy balance of leverage. They want 2025 to have less than 3 times net leverage. They're currently over 4 times. So they have a lot of work to do to get to under 3 times net leverage. If they really want to achieve that, they have to increase revenues, increase EBITDA, and hopefully also pay down some of the debt that they've been taking off. And then 3 and 4, in my opinion, shouldn't even be on the page for how much debt the company has. And if they do truly believe in these ROIs to fuel, they shouldn't be thinking of investments or acquisitions or buybacks at this point. They should be paying down debt and accelerating whatever projects they have underway to turn them from capex into revenue generating opportunities. And they even call out here, I didn't notice that, the high ROI opportunities they've highlighted is building out Topgolf venues that they say here and expanding Travis Matthews stores. I believe that's internationally is their hope there. So that's kind of how the company's spending money and what they're likely doing with that incremental $600 million of debt that they recently took out. And then this is just showing the net debt leverage ratio year over year. So trailing 12 months EBITDA up a couple percent, but the debt is significantly higher. Net debt went from 1.4 to 2.2 billion. Now they're over 4 times net debt leverage ratio. So I think that's really what's once again holding back their valuation. Going back to the stock here, I think this stock, given how they've positioned it with loaded up on debt, have really bet the company's equity essentially on the ability to profitably build out the Topgolf franchise. If they're unable to do that, or Topgolf doesn't pay out, doesn't become profitable, or if a bad recession hits at the wrong time, it's not going to be a good situation for the equity holders with all the debt the company's taking on. And that's partially what concerns me about the company. I think it's a pretty risky play because of that. You're betting on strong economic times, or at least decent economic times, the financial model of Topgolf to continue to hold true as they expanded in more and more locations around the U.S. and in less and less target states, right? If you have 80 in the top 80 places that have a Topgolf, that 81st Topgolf won't be as productive as the 80th, hypothetically. Definitely not as the top 10. So it'll be interesting to see at what point they hit critical mass and these investments start taking longer to pay off. At what point they would likely slow down, or they should slow down building out the network. But it's just a really big bet on Topgolf. I think if someone wanted to make this like a small portion of their portfolio or a bit of a speculative play, may be worth it. I can definitely see a world where this company trades at a higher multiple than 0.7, 0.6 times revenue for sure. And especially if they're able to get that $4.5 billion to $10 billion of revenue, and they have 10% net income margins, that would be $1 billion in net income. You can slap a 15, 20 times multiple on that, potentially, depending on market environments. And this can be a company that's trading at $80 a share. So there's definitely a heavy potential of reward on this one, along with the potential risk that comes. So my personal opinion is, even though it's a pretty developed company in terms of the brands they own, where they play, and the market cap being $3.5 billion, this is still pretty speculative just because of how they've organized their debt. They're investing super heavily no matter what the interest rate environment or economic climate is. So I'm treading carefully. I'm going to keep it on my watch list, but I'm definitely not jumping in to this one. It's also interesting, over the last 30 years, the company's moved all over the place in terms of valuation, but has really gone nowhere. So that I wouldn't say they have a strong track record necessarily of creating shareholder value as well, which I like to keep a look on when I'm debating what companies to invest in heavily. So that's a bit of the background on why Topgolf Callaway stock has been crashing over the last year or so, down 7% again today, and my thoughts on where I see this company in my watch list and in my opinion moving forward. If you like this type of content, be sure to subscribe to the channel. Like this video for more if you're still here. Liking this video really does a ton for the YouTube algorithm and helps me out a lot, so I do appreciate it. Thanks, and I'll see you guys in the next one.